Hello again. My name is Marty Frenkel. I am chair of Maddin Hauser's Financial Services Group. Today is our fourth and final installment in our video blog series regarding movement in the mortgage industry. As you may recall, in our last episode, we discussed due diligence issues in the context of a merger and acquisition from the acquirer's perspective. Today with me is my partner, David Freedman. David, let's unpack the other side of the transaction. We have a successful closing.
Yes.
So let's talk about post-closing matters.
Absolutely.
What is the general concept of a post-closing matter?
Sure. So a post-closing matter, and often this does not get focused on too much, is all the important things that are going to happen after you close the deal that you don't want to think about. Commonly, we might deal with things like purchase price adjustments. We may deal with escrow and escrow releases. We may deal with earnouts. We may deal with promissory notes. We may deal with third-party consents. They're all important, and they're all something that we need to focus on.
Why should the parties care about these post-closing matters? I made my deal. Why should I care?
Because you might be leaving money on the table and you're not focused on it. If you're the seller, there's a high probability that there are monies that are being held back, and you want to ensure that wherever those monies are going to ultimately go, that some of them filter back to you. If you're a buyer, you want to make sure that there are monies that are reserved or held back and possibly available for post-closing liabilities. That's why parties use escrow. You want to try to minimize the amount of disputes that you have with respect to the parties. You want to try to avoid issues that go away from efficiency and arguments and things that are just not helpful. And ultimately, you want to make sure you got the bang for your buck.
So that's a perfect segue to what is a purchase price adjustment and how is that handled from buyer perspective and then seller perspective?
Sure. So a purchase price adjustment is sort of like a true-up or a reconciliation of the purchase price, and it's meant to focus on what the actual value of the business is at the time of the closing. The parties will typically create the purchase price well in ahead of the closing, not knowing exactly on the day of the closing where it's going to be. So there could be what we call working capital fluctuations. And typically there is a target or a peg, which is called target working capital, that the parties will agree on. And that's the number where the parties want to have it when they close. So as an example, let's say that the target net working capital is $500,000. And by definition, just in a general sense, that's net assets minus net liabilities. So the seller will take the first crack at it and crunch the numbers with their accountant and their internal people to come up with what they determine the net working capital number is. They will then, in turn, provide that to the buyer and have the buyer's people take a look at it to see whether there's a meeting of the minds. If they do, then adjustments will be made for purposes of adjusting the purchase price, and usually there's an escrow there available. Typically, if the seller is going to owe the buyer money, there's monies in the escrow that are available to release to the buyer to take care of that. If, on the other hand, the buyer disputes what the net working capital amount is and it can't be resolved, then usually in your purchase agreement, there will be a third-party accountant who is independent, who will evaluate that, who has a limited scope and purpose of their engagement, and whatever he or she determines is going to be valid and binding, and that's what the parties have to go by.
So would it be fair to say that if you have a well-drafted purchase agreement, you essentially have this choreographed procedure or dance that you're going to go through from both a buyer and seller perspective to drill down and make sure that post-closing both parties got what they thought they were going to get?
Very much so.
Along those lines is the concept of an earnout.
Yes.
Talk to us about what an earnout is and how that's addressed post-closing.
Sure. So an earnout is a contingent payment that would be payable from the buyer to a seller post-closing, depending upon the buyer who has now inherited or bought the assets of the company in terms of what their financial performance is over a period of time. Maybe there's a 1 or 2 year period. It's favored by buyers because they don't have to come up with as much cash at closing. They will park that money in escrow. It is disfavored by sellers because they're not getting everything that they think that they're entitled to. They think it's an unnecessary holdback, and we have to work hand in hand with our clients to sort of say, hey, if you feel good about this, you're going to get 85% of your money now, you're going to get 10 or 15% down the road. Not a guarantee, but this is sort of how this is going to be structured. It's an important thing for purposes of how this is dealt with to have your attorney vet the document in terms of the earnout, because there are certain games that, let's say, a buyer could play to depress the value of the company, and you want to negotiate certain negative covenants or restrictive covenants that allows them, that restricts them from having to do certain things or doing certain things that are going to skew that number in performance and ultimately try to not have to pay those monies to the seller.
From a buyer's perspective, also, an earnout is important for retention of key employees from the acquired company. Isn't that also accurate?
Yeah, it gives you sort of the laneway to have that extra cash available to incentivize or pay these people to come over and work with you.
What is an indemnification escrow agreement?
So an indemnification escrow agreement is meant to deal with potential post-closing liabilities that a seller would have to a buyer as a result of certain things that arise as a result of your purchase agreement. There could be a potential breach of reps and warranties. There could be a potential breach of covenants that are made by the seller. There could be some trailing liabilities that are being dealt with. There could be vendor contracts that need to be dealt with. And so typically a buyer is only acquiring certain of the assets of the seller. The seller has an obligation and a responsibility to pay these other liabilities. Seller's going to sort of be gone and can take all the cash and the money away. So what do? You take a certain set of money that would otherwise go to the seller. You would park it with a third-party escrow company. Typically, we've been using title companies. And you now have an independent three-party escrow agreement between your escrow agent and your seller and your buyer. And you either have one tranche of money or several buckets of money, depending upon the certain things that you're dealing with. I will note that we're seeing more and more these days, particularly with bigger transactions, a concept of rep and warranty insurance. So that puts less onus on the use of an escrow agreement and more on buying the specialized insurance that's available to pay certain claims if there's legitimate claims that the buyer may have where you don't necessarily have to hold back the money. It's sort of outside the scope of the video, but usually there's a certain percentage holdback based upon the purchase price, and then based upon that holdback, there's a certain percentage inherent cost that you would pay the insurance company. So those are being used as well.
You know, one of our prior episodes on the due diligence side of the equation, we talked about identifying key vendor contracts, leases, other agreements that the acquired entity had in place at the time of the acquisition. What role do assignment and assumption agreements provide in that context?
They play a very important role. I think that they tend to, they're not missed, but I don't think people spend the proper amount of time focusing on it. From a buyer's perspective, they're like, okay, I want your contract. Why don't you assign it to me and I'll assume it? And the seller, conversely, has the same concept. I have this lease. I have this vendor contract. You want it. I'm going to assign it to you. You assume it. I'm responsible for everything that happened prior to the closing. You're responsible for everything that happened on and after the closing. The problem is you have a lessor. You have a vendor. You have a landlord. And so now you have what they call a tripartite agreement or tri-party agreement. There's three people that are involved that you need to deal with. So we as attorneys typically will craft a very flexible assignment and assumption agreement as a model and template that can be used for these transactions. We get that going early in the process. A lot of it sometimes does happen post-closing, and we will interface with a business person, let's say from the seller, who will then interface with the landlord or the various lessors to present to them this document for signatures. And I would say 75 or 80% of them go very smoothly. People sign off and the parties move on. And then there are those that there's some negotiation, they get counsel involved, and that's where we come in. Maybe there's some questions about indemnity, maybe there's some questions about a deposit, there's some question maybe that they want a guarantor. Sometimes these leases have subleases and sub-subleases, and so there's different levels of things that need to be dealt with. But it's a very important thing, and you have to really coordinate that well with all the parties to make it happen and stay on top of it.
One of the things I hear you saying is oftentimes parties are really excited. We closed our deal, the acquisition deal was closed, but issues like assignment and assumption agreements, you still need to connect the dots after the deal is done.
Absolutely, absolutely. And that's one of the things that I kind of harp on. Just because you've closed your deal and whatever side you're on, you're all excited about it and you spent all this time and you're closed, there's still more things that you have to deal with.
One of the biggest assets to the purchaser can be the employees of the seller. So describe for us some employee retention matters that you will face post-closing.
Sure. So, I mean, the most obvious one is the employment agreement that the person is going to have to sign. How does it look relative to what they're used to? Is there consistency and continuity in that relationship? Also, there's concerns about being able to poach people and do different things. So that's where you get into non-solicitation provisions, both with respect to employees and also vendors that you deal with. An interesting thing here, particularly if you have a principal of the seller who's going to work for the buyer, and so now that principal is now getting some form of an income, whatever the agreement is. Oftentimes you will find in that person's agreement a right of offset. So if the buyer has a claim against the seller, and let's just say that there's not sufficient amounts or any amounts set aside in escrow to do that, oftentimes the buyer will want the right of offset in this employee's agreement so that they can basically take the money that would be otherwise due him and pay their claims. And that's a heavily negotiated item. Also, you will find a particular loan group, let's say from that is moving over from the seller to the buyer, and they have trademarked their name, or their name is out there in such a way that it's well known and it has value from a marketing standpoint, and they want to make sure that that name is still being used. And so typically the seller might already have an assumed name for that name, but we can get around that by sort of using that name and adding some additional words to it. So let's say that you're the Baker Boys Loan Group, but now you've been acquired by XYZ Mortgage Corp. You can say Baker Boys Loan Group powered by XYZ Mortgage Group, and we will wind up filing assumed names for you to do that. Also, there are the Nationwide Mortgage Listing Service, commonly known as the NMLS, where you have to, it's sort of a national repository for all mortgage loan originators and everyone else in terms of license information. What states are you licensed in? What do you have in terms of licenses? and they need to be informed, and they actually need to consent on this. See, there's a whole process to get that going. And also, based upon this acquisition, there may be scenarios as a buyer where you may not have been in certain markets in different states where you have to foreign qualify yourself. Maybe you're a Delaware corporation that's qualified to do business in 10 states, but now because of the acquisition, there's 10 more states. We will assist you in those foreign qualifications in those 10 additional states to get that done.
So David, I know you're just scratching the surface on a lot of the post-closing issues.
Yeah.
But if you could summarize, what is our client's role in post-closing? And as counsel to our client, how do you see your role generally in post-closing?
So that's a good question. What I try to do in advance of the closing, let's say at the same time that we're preparing a pre-closing checklist, I'm preparing a parallel post-closing checklist, just as important as the pre-closing checklist. And I'm in front of the conversation with the client and advising our client contacts that, okay, we're scheduled to close 10 days from now, and at that time, some of the fun stuff is over because we've closed and it's successful closing, but now we need to deal with all these ancillary things that we've discussed during this video in terms of purchase price adjustments, as we discussed, escrows, maybe there's an earnout where there's a promissory note that's going to pay you, third-party consents on assignment assumption. So we need to get all of that in front of the client. We need to make sure that the client is engaged, and we need to politely but firmly make sure that the client moves with us down the road to accomplish all of these things. And if they're a willing participant, which they are, then everyone will be somewhat satisfied at the end of the day, depending upon sort of where the monies go that we've been holding back and things like that. So it's a sort of a collaborative, concerted, hopefully efficient effort to make things happen. And you know, the theme here is that, just as you mentioned at the top, just because you've closed a transaction doesn't mean you're done. And so I'm here to let people know that there's more to a deal and a transaction than just the front face. There's a back face as well.
Well, thank you, David. Our clients are glad that you're on their team.
Yes.
And we have done several of these deals, and the best deals are the ones that don't have a lot of problems post-closing.
Yes, yes, absolutely.
Thank you for attending our fourth and final session on movement in the mortgage industry. We look forward to seeing you on other topics in future.